afternoon, everyone. So the last session for the day, short, sweet, crisp questions and short, sweet, crisp answers. To begin with, I'd just like to profusely thank the management of pmsbazaar to give me an opportunity to moderate, because over the last 18 months, I was sitting there and I was answering questions, and Mr. Market was such that any answer that you gave, it came true. But now, no more the case. So happy to sit here, and this gentleman will do the answering at this point in time. Thank you so much for that. So, how do portfolio managers stay ahead of the curve? So it's like, when you talk about portfolio managers staying ahead of the curve, it's like a running race, but there's no finish line. And on the track, there are a lot of banana peels that are thrown in. It can be in the form of a tweet from a political person, or it can be anything, or it can be our own valuation mistake or our own entry point mistake, etc. So I'll start with Achin here. So how are you navigating the current situation? If you could throw your thoughts on that.
So I think interesting times, Balaji, and like you rightly said, today we are sitting amid such a volatile environment. It's very challenging to really foresee next 5 years, because you don't know when the tariff war is coming. You don't know when the geopolitical tensions are escalating. Right now, we are seeing a lot of movement across the border, so it is a concern right now, right? But has that not been the case before or earlier? See, I always feel that markets have been always on the edge. It's not today or tomorrow. COVID was there, then you have Israel-Hamas, you have Russia-Ukraine. Events will be always there. Point is, when you navigate, are you foreseeing that in the coming event, are you positioned in the right sectors? Because whenever these events happen, the correction is followed. And whenever the correction happens, the sector shift happens. So we at Bonanza is very clear that when we are navigating, we are focusing on the trends, on the sectors. And definitely within that, all the fundamentals hold true, whether it's a P ratio, whether it's PB ratio, whether earning growth, these are the fundamentals, right? But overall demographics, is positioning India in a very good manner. And I see our economic growth, have no question. We will be leading the economy until 2075 is what I feel. So yeah, that will be my take. Sorry.
Arun, your thoughts? You feel has the market structure kind of changed over the last 4, 5, 6 months, and how are you navigating at stage 1?
So, first of all, thank you PMS Bazaar for having me for this conclave. I believe we as a fund house think is that we have a particular investment strategy, and the only thing is to follow it in a very disciplined manner. Noise, volatility is a daily routine part of your investment journey. If you're able to maintain your investment strategy and follow it in a disciplined manner, you have to be more concerned with your investee companies and how they are doing at the end of the day. Index per se, I think, are not the absolute correct benchmarks per se, because the constituents are very different. And we as a fund house, when especially we are in the mid-cap, small-cap space, sometimes the index become irrelevant for us. So I think as long as my investee companies are performing well, there can be a short-term blip because of the market volatility. But as long as they are growing, I think in the long term, eventually they'll give you the kind of return that you are expecting out of it.
Dhawal, buy, ride, sit tight, Motilal Oswal, do you feel that no better time to be doing that, buy, ride, sit tight in the current atmosphere, or you feel that there has to be much more churn to adapt to the newer situation?
So if you see our history of last 3 years, we have actually moved away from buy, ride, sit tight. So we have moved, so buy, ride is important as a part of any investment journey, but selling ride is even more important. So your question in what is our phase, what is our view on in the current market scenario? So times are challenging. Obviously, times are volatile, and it's expected to be volatile. But if you see the history of capital markets, the beauty of capital markets is for the same news, market never reacts twice. If you see last 25, 30 years, for the same news, market never react twice. Now the entire Trump tariff news is out there. The only thing from here on is there will be improvement. Unlikely it is going to deteriorate from here on. You're already hearing news that they are also discussing with China to reduce the tariff. So the recent example like COVID, when COVID happened, we saw a correction from Jan to March 2020. Post that, first wave, second wave, third wave. Second wave was much more brutal than the first wave. Market didn't react. If market knows the playbook, market will not react. Russia-Ukraine, again a classic example. War is going on for 3 years. Market reacted for the first time. There are n number of other events which had happened during that war frame in last 3 years. Market has not reacted. So structurally, we strongly believe that market or India will be in a far stronger position 3-6 months down the line compared to what it was earlier, because we are of that view that world has moved from multilateral treaties, multilateral agreements to more of bilateral agreements. So it will no longer be the WTO or MFN which will be ruling the world. It will be the bilateral agreements between two nations which will be the way forward. And if you see India, I think this time around they are way ahead compared to the other countries in terms of signing a bilateral agreement with US first. Why this time around I am saying they are way ahead? Because, so if you see this entire China plus one as a terminology which was formed by Mr. Market, I think in 2017-18, when during Trump 1.0 regime, he started imposing tariffs on China. Now, at that time around, if you see the entire China plus one beneficiary, countries like Vietnam, Philippines, Thailand were the key beneficiaries. India was also one of them, but the larger part of the beneficiaries were the 3 countries above. Like a country like Vietnam, 30% of their GDP is based on US exports. That's the transition shift which has happened in the last 7-8 years. India is just around 3-3.5%. If you see this time around, I think our bureaucrats are much more agile. They had seen this coming, and we will be among the first to sign the treaty, and I think our treaty will be far better compared to what we had seen in the past. So that's what our understanding is, that there is a volatility in near term, but I think India will emerge much more stronger when dust settles.
Thank you for that. My ex-boss always used to tell me that how you start your career, that's how your mindset is. Suppose you start your career in a bull market, you're generally a very optimistic, bullish person. Suppose you start your career in a bear market, you're much more skeptical and cynical. I mean, all of us here would probably have 20 years plus or minus experience in the financial markets, money management, etc. And Achin, this question, right? So we've always been used to a globalized world, globalized economy, free markets, etc. But now it's like a complete 180-degree shift. You know, we're trying to move into a deglobalized kind of an economy. So that's like a huge mindset change that is required. So now when you look at an idea, are you kind of looking in that angle, or what is it that you're doing?
So, I mean, definitely, globalization you cannot ignore. It still remains the part of it. But given the new tariff wars, given the uncertainty, India has a unique advantage because, we are predominantly a consumption-driven economy. So when we are looking for new ideas now, definitely with the uncertainty in the, global environment, you focus on those stocks more which have either niche when it comes to exports, which have a low reliance on imports, which primarily means, it's a internal domestic driven stock. So that definitely is the shift in terms of stock selection today. And I believe, definitely, but exports and imports or the globalized stocks will continue to form around 10-15% of the portfolio. But majority focus is now gradually shifting back to domestic. So that's definitely the case.
So Parin, one view is that as it is, in a globalized economy, we did not really fire so much in the exports world. So it's more like ignorance is bliss. So as a country, we don't have export concentration, neither do we have import concentration. So we've always been an inward-looking economy. So therefore, the impact or the hurt will be much lesser. Would you concur with that? What are your thoughts?
No, so I agree to the fact, as you mentioned. But if you see the last 10 years of this government, from 2014, the mindset has somewhat changed, and there's a clear thought process that manufacturing contribution to the economy has to significantly go up. We can't be more agrarian dependent anymore. And all the steps, be it PLI or, the other incentives, state government incentives which are coming through in the form of GST, write backs or whatever to those companies, are to encourage manufacturing. And at the same time, exports as well. This tariff war has, of course, made few things disarray in the form how it is going to happen. But in the whole scheme of things, I think India will eventually turn out to be a big beneficiary of this. I think government in the last 10 years has done its job in the form of government capex, which has come through. It is now the private capex which has to really ignite its animal spirit, I think. The bigger problem is that the capex has slowed down. Having spoken to some of our companies, not that they are sitting in abeyance, but they've just postponed their capex plans right now to see how this entire episode settles down of the tariffs. But I'm very sure that given that the capacities China's built, India somewhere has to take some risk in the form of capex and build capacities if we want to take advantage of exports. And I think it will come through. So, and you have to identify those companies who are actually going to do that with the kind of promoter aggressiveness which you can see. So definitely, so see, then the bottom line for me again comes back to the same my investment framework, where I want to look at companies where my earnings are going to double in the next 3 to 4 years. If my company is able to do that, then I'm very okay with, and if I'm getting it at reasonable or fair valuation, then I'm definitely going to look at it, whether it comes from exports or comes from domestic, it doesn't matter to.
Yeah.
So one interesting fact is that the manufacturing monthly wage in US is about $5,000 per month. Manufacturing monthly wage. In China, it's about $1,000 per month. And in India, it's about $250 to $300 a month. That's right. So India is about 1/4 of China, and India is about 1/20th that of US. So, Dhaval, of course, you mentioned about China plus one. I'd like to insist there where there was a bit of a false start post-COVID. But do you think this time we can really see the China plus one kickstarting?
So we strongly believe that this time around, I think the real benefit of China plus one we will see once obviously the bilateral agreement is signed between India and US. So we are already hearing news. I think yesterday only it was covered in ET. No one knows how much true it is, but Apple, a company like Apple is planning to shift a larger part of the supply chain from China to India. So see, after this entire episode of last 3.5 months, the entire global supply chain will resume. That is given. Now, in this episode, there will be newer industries, newer companies which will emerge. You mentioned about the overall wage. Now, a country like US, where the per capita income is $82,000 something, will not be able to manufacture steel. Even if they want to, the cost competitiveness will not be viable. So for them, they have to depend on commodities like steel on other countries. In this entire region which I mentioned, I think India will play a far bigger role. And I think our bureaucrats are right up there, and I think India will be the first to sign the treaty, and you will see that benefit playing out in ensuing years.
Thanks for that. So we'll move into some themes and what our panelists are looking at. So Achin, you have had a positive bias towards gold loan. Correct me if I'm wrong. So of course, gold, there's a bit of a FOMO. I mean, there are two schools of thought about gold. One is that the retail is not yet started buying. It's only the central bank buying. The second is that no, even the Chinese retail is FOMOing on gold and stuff like that. So of course, you don't have exposure to gold, but gold loan companies, a lot of their fortunes are determined by the gold price, etc. So what are your thoughts on how do we approach this?
So in our strategies, we do have 2 odd companies which are into gold loans, and definitely, with the gold price rising, it gives advantage to both the lenders and the borrowers. I mean, lenders have a good, risk coverage ratio. With increasing gold, their price decreases, and borrowers, they are able to borrow more. But beyond a certain point, a tipping point, you are over leveraged, because there will be a correction. There will be that you will see beyond a point, it will not be sustaining. And you rightly said, countries are buying, the gold price is increasing because of the buying by the treasury. It's not the real consumption. So some point that correction will happen. And if you are over leveraged at a point of time, it will again trigger a massive sell-off. So one has to be really clear between the advantages and the disadvantages. So I feel for the timing, we are in the safe end, but maybe 3-6 months down the line, we would be trimming down the positions, because when we feel it's leveraged. So right now, it's a good go for anyone.
But for say FY26, what kind of themes you're looking at? How are you positioning both Edge and the AG's portfolio?
Yeah. So again, that's interesting. Now, Edge is something which is special opportunity, and there we look for the stocks where there can be catalytic trigger. So it's not a sector base, but it's more of a opportunity and a stock base, bottom up primarily. And there we have some interesting bets. But Aegis is something in which we position short term. Now, Aegis means protection. Now, this is something where we determine the sector, and some of the sectors right now we are positioning our portfolio is towards defense, renewable, and PSUs. I feel PSUs and defense are back in favor after some time. So these are our current portfolio shift, and definitely there are some satellite stocks which are like again bottom up, but these are the main themes. I mean, renewables again. I think there was data like 500 gigawatt is the projection by 2030. And we have already achieved 235 gigawatt, out of which solar is around 95 gigawatt. So I think we are on the massive bull run again for wind, hydro, and solar. So it's a game picker for next 3 to 4 years.
Areen, correct me if I'm wrong, but 𝐭 likes banks, NBFCs as a space kind of overweight on.
So we have a very large exposure to financials. So I'll put financials in a very broader theme where it's not just banks,
Right.
but it's the entire
On lending.
Correct. So I would play it through NBFCs, AFC, home loan finance companies, insurance, capital marketplace. So for me, how we look at it is, suppose it's a play on the end user market at the end of the day. If I'm liking housing, if I'm liking real estate, but I'm not finding a stock decently valued or anything in that particular space, but I'm finding a housing finance company which is reasonably valued, then it's a theme for me. It's similarly, as Achin said, renewable space. If I don't get a value play in form of module manufacturers or IPP generators or anything, then a power financier. And if it's reasonably valued for me, it becomes a proxy play for me for the power sector. So actually banks is a very small exposure for us per se, but as financials, as capital marketplace, we have insurance, we have power financiers and all this in the portfolio, which gives me a broader exposure to the financials in the portfolio.
Dhaval, you like this value migration themes, right? So that's again a personal favorite of mine. So keep on looking at value migration, and of course, in hindsight, it was very easy to say that from value migrated from say PSUs to privates in the early 2000s, then from a two-wheeler to a hatchback, and so on and so forth. Even now, value migration seems to be happening. But only thing is, I may be completely wrong, but for example, if you take say the revenues of say YouTube revenues in India is about 15,000 crores. Which is more than Sun TV plus Z put together. Value is migrating, but is value migrating to the unlisted space? Because you are in India, you can't buy an Alphabet. You can through ETFs, etc. So auto, like if say for example, if Maruti is losing market share, BYD is gaining, so you can't play BYD. So is the value migration at this point in time happening from the listed to unlisted? Or do you still find opportunities in the listed space? If so, if you could throw some examples.
Yeah, sure. So there are a lot of opportunities even on the listed space. So see, what's the genesis of value migration? There will always be a time frame where the profit pool will shift from, let's say, company A to company B. Why the profit pool will shift from a company A to company B? Whether there will be a product differentiation, a customer service differentiation, which you mentioned about PSUs and private banks. There will be a process differentiation. There has to be some unique thing about a different company where there will be a shift from company A to company B, and company B obviously would be doing far better in terms of market share gains. So if there's a recent example of value migration is the entire channel shift. So quick commerce as a space was not even born 3 years back. No one knew quick commerce as an industry 3 years back. But so if you see historically, whenever you do grocery shopping, two things are utmost important, not only in India, globally. One is price, second is convenience. Okay, your erstwhile value retailers like DMart gave you best of the price. But obviously it was not convenient to buy via DMart because there was obviously a waiting period for, as well as it was quite crowded. The earlier avatar of e-commerce companies gave you convenience, but if they were giving you price, they were not profitable. So there was no longevity in the business model. Now, the new avatar of quick commerce with the entire hub and spoke, with the dark stores, they are giving you convenience, the best of the convenience, and the price which is quite competitive. And they are very, very profitable. So, at the current juncture, in just 3 years, they are 1.5% of the grocery industry. I would not surprise it will be 6 to 8% in next few years. And not only that, right now the focus is on grocery. So think that way, it's an online mall. आप अभी खाली grocery buy कर रहे हो. There is a possibility tomorrow you will buy electronics, you will buy apparels. So there are footfalls and there is an online mall. So that there is a landscape shift which we have seen from a value migrating from general trade, which still is a larger part of the industry, to a completely newer channel, which is like a quick commerce.
So I'll stay with you there. Ekta from Karma Capital had a beautiful slide. She mentioned a slide where there are some industries which are going from fragmentation to consolidation. Some are going from consolidation to fragmentation. So you mentioned about quick commerce. So if I'm a Britannia or any other FMCG company, I can bully a distributor and say, you have to keep 100 kilos of my Good Day biscuit.
Correct.
So my Britannia, I will pay my maida guy, sugar guy, milk guy after 40-50 days. And my inventory is in the distributor's balance sheet. So my working capital was always negative. Now Britannia now cannot afford to do with a consolidated channel, because now there are only 4 guys, Zepto, Instamart,
Correct.
whatever.
Correct.
So the bargaining power is kind of shifting from the traditional FMCG to quick commerce. Would you agree with me on that?
Yeah, 100%.
So in that case, would you see derating in the current FMCG companies?
So there are two ways to think over there. So if you see current FMCG companies, the larger part of the last decade, I'm talking pure play staple companies, the larger part of the last 2 decades, their growth was because of 2 things. One is your penetration-led growth, and second was of increasing in the consumption. Now, both the stories are largely played. Now, if you see how the landscape has changed in the last 5 years, because of quick commerce, because of D2C brands, the competitive landscape has changed. If let's say I am a newer brand, 5-7 years back, if I used to go to a GT would have never allowed me to keep entire shelves, because for them, their inventory shelves is limited. That's a real estate. The cost is real estate. If I am a new brand, they will never ever put me over there. But now, if I am a new brand, a quick commerce or any other online retailer will put me over there. And that's the competitive landscape which has changed to the earlier FMCG players compared to what we are seeing now. And our sense is that the larger part of the penetration distribution game which was played in the last 2 decades is also largely done. So that's why if you see in last 4-5 years, the growth has drastically come down compared to the historical past. And our sense is that unlikely you will see most of these companies growing in double digit in terms of revenue on a sustainable basis.
I want to ask you a slightly different question. So in the sense that you've been heading investments in 𝐶𝐽1. Now, when you're talking about research, the idea is to always stay ahead of the curve and beat the benchmark and sustainable long-term risk-adjusted return and all that. So compared to say 5 years back, pre-COVID and now, what does your typical day look like for research? Because before pre-COVID, there was a lot of manual thing, BSc ka, her notification you have to see and so on and so forth. Now there are a hell of a lot of tools that have come in, right? So you have ChatGPT, a notebook, and how are you now rationalizing your time, and how are you using these tools to stay ahead of the curve?
AI tools now form a big part of our research process, to be very honest. See, the qualitative aspects, the intuitiveness is still going to be human-led. You need that X factor to say whether this company is good or bad, which maybe a AI model cannot tell you. However, it brings tremendous amount of efficiency and productivity. That I have to give it to it. So a lot of our time now, because as far as quantitative is concerned, numbers is concerned, making Excel sheets or whatever is concerned, these AI tools are able to do it faster. It gives you more time to deep dive physically or to go on the ground and do your work, which our team is very active on doing ground research. So it gives us little more time to do that rather than sitting and making those reports and time consuming. So AI tools has become a very large part. You have subscriptions to most of them, and and the entire team from the top uses it very efficiently as well. It gives you more time basically to now do your physical work on the ground which you wanted, which earlier used to take a lot of time because you have to sit in office and do the other parts also. Now that part has become faster and more efficient for us.
Achin, in Bonanza, what kind of tools are you using, or it's still the good old manual way of doing it, or?
So definitely there is a blend of both. I always feel that, you have to leverage technology. Otherwise, you will be out of business, as simple as that. We have our in-house tech. So I am also passionate about technology. So over last few years, we have really invested heavily in tech. And we have our in-house tools in which we definitely use, predictive and, algorithm-based analysis. And sentiments play a critical role in our analysis apart from the quantifiable data. So I would say apart from the tools available in the market, which do help, we have our in-house technology, and we also are tying up with few AI ML based companies who are already at an advanced level. So point I'm trying to make is whether it's in-house or outsourced, we are leveraging technology and we are using it extensively right now. And traditional ways do not go. I mean, if you have to out from the markets, I still feel that manual intervention, that assessment of the volatility, it continues to play a role. So, I mean, my thought process is that you leverage it, but you use it. I mean, don't let machines take over you. So that's how we do.
So just a slightly loaded question for all three of them. So far, it's been low full toss balls. So we are all pro manufacturing. Do you agree with that? I mean, are we pro manufacturing and we are bullish on Indian manufacturing story, right? So Dhaval mentioned about limited shelf space for general trade. So if you take Nifty 50 as an index, Nifty 50 also has a limited shelf space. There can be only 50 stocks in Nifty 50, correct? So there is hardly any manufacturing in Nifty 50, except for maybe auto, which is 6-7% of the index. Everything else is banks, IT, FMCG, they're all services oriented. So if you are pro manufacturing, so manufacturing companies will become large and at some point in time will find a place into, say, Nifty. So which means that somebody has to get out of Nifty, correct? So which sector in the next 5 to 10 years do you think the weight of that sector will fall in Nifty? Dhaval, any?
Okay, I understand it's not a local toss. Okay, so our sense is two sectors which what my senses will weight will reduce in Nifty 50 over the years. See, all these themes happens in decades. It's not going to be tomorrow or a year after. It's a decadal theme. One is the IT sector because we strongly believe that structurally the best part of the growth in the large cap IT space we are done with. Unlikely now you will see a 7, 8, 10% constant currency growth for large cap IT players on a consistent basis. It will be largely in that mid to low single digit constant currency growth, and there is a possibility in few years there can be a negative constant currency growth also. Second, which I highlighted, I think is again coming to FMCG. Obviously, they are all, so see, all these companies are wonderful companies. Okay, be it the large cap IT companies or be it the large cap FMCG staple companies are excellent companies with a strong lineage, strong pedigree, and people have made billions or millions out of all these names. But going forward, India has always been a growth market. People come here for growth. And I don't see a very high sustainable growth in both these sectors, to be honest. And given that framework, they will lose that charm, which was obviously not the case in last 2-3 decades. So again, as I told you, it is not going to happen tomorrow, day after. It's the decadal theme. But yeah, that's what our view is.
So it's a very important point, dear audience, that Dhaval has made, that IT and FMCG could probably see a reduction in weight over the next very many years. So he's talking about 1/3 of the Nifty because IT has a 15% weight. FMCG also has a 15% weight in the Nifty. Pareen, your thoughts?
It's actually a very tough one. But see, the way the calculation is for a stock to get into the Nifty is also on the free float market cap basis. So, a company can do extremely well. The market cap can be really good, but it will not be a part of the Nifty. Having said that, again, taking from Dhaval, if the EV space really plays out and the share of ICE engine autos keep coming down over the next decade, then you can see some oil and gas company. And because, again, the formula, the way it is, you could see oil and gas having lower weight in the Nifty compared to what it is today.
Achin. So my take is a little different. I mean, I feel because you pose this question, should I think that manufacturing be part of Nifty 50? I mean, I differ with this fact that it has to be Nifty 50 for, to be the leader. It may be in the next 100, all these things. And I feel the sectors that we have positioned are high growth sectors, and somewhere like, Parin said about the market cap and the free float have to be there. So my guess is manufacturing will have its own sweet space. And should I be worried that it will be in top 50 and some sectors to come, to give that a space? I think that dynamics will play out, but I really don't foresee that it will form a substantial portion. I mean, you have one company today, maybe you have one or two more companies later, and the shift can be anything. I mean, so my view is a little different on that.
Sure. I mean, these are very important points made, and I urge you all to check PMS Bazaar website and see their returns, Bonanza, Sage 1 and Motilal, a tremendous alpha generation over 5 years, 7 years, etc. So we are coming to the end of the panel discussion. So I think, I just designed a small quick fire questions. So depends cannot be an answer. That is the rule. So these are all typical questions. So starting with you, Achin, diversification or concentration?
Diversification.
Parin?
Concentration.
25-30 stocks. Whether you say diversification or concentration, 25-30 stocks.
What keeps you awake at night? Error of commission or error of omission?
Error of omission.
Omission.
Commission.
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 What kind of company entices you? 10-year consistent ROC of 20% or subpar 6-7% ROC with the possibility of it going to 20% ROC? Achin?
Subpar 6% with the possibility of 20% going.
Parin?
The second one. Subpar going to 20.
That's where the money is made. Subpar to going to 20%, you also see PE re-rating across the time frame.
Nalanda may disagree with all three of you. Management meetings, are they underrated or overrated?
Overrated.
Parin?
Overrated.
Yeah, it's overrated.
Overrated. Last and final question, and I'm from Chennai. Please be conscious of that. Dhoni or Rohit Sharma, who's the GOAT?
You are a moderator, so I'll go with Dhoni.
As much as I love you, it's Rohit Sharma.
So even though I am from Mumbai, but I still prefer Dhoni.
Thanks. Thank you all for your time. Thank you.
Thank you, boss.